Go to illustration 3. P Limited, a listed company, acquired 60% of shares on 1/4/2000, date error, 1/4/2020. Okay, at a cost of 138 lakhs. At a cost of 138 lakhs. So this one. 138 lakhs represents which one? Shares in the other company. 138 lakhs is nothing but shares in the other company. Okay. Q Limited's book value at the beginning of the year is given. Fair value at the beginning of the year is given. Book value at the end of the year is given. Then we are given balance sheet of which company? P Limited. Prepare consolidated balance sheet as on what date? 31st March 2022. So do they ask you opening consolidated balance sheet? No. They ask you only what? Number one, closing consolidated balance sheet. Number two, do they ask you separate balance sheet? No. Only which one? Consolidated balance sheet is asked. If you look at the working X, Y, Z, P, Q into up arrow, then you will have a doubt. Okay. So don't. This is a working. This is a solution. Okay. The solution is given. So this is part of solution. Don't go through the solution. We'll solve it in our style. We'll solve it in our style. Start. Shall we? What is step 1? Proportion of shares held and cost of investment. Okay, what is the proportion of shares? P Limited holds how much percentage? 60%, and the other company, NCA holds, of course, 40%. What is the cost of investment? 138 lakhs. Take it up along with me, no need to wait. 138 lakhs. This is step 1. Step 2. Fair value of net assets. Of which company? Q Limited on 1/4/2021. That is when the shares are acquired. I hope we are given fair values of assets. Fair value PPE, other current assets, inventory, then borrowings, trade payable. What is the value of PPE? 200, fair value. What is the next one? Inventory. Other non-current assets 60. Less what enough? Borrowings 60. Trade payables 20. That will give us fair value 28. So it will give us fair value of net assets. How much? What is step 3? NCA can be valued based on proportionate net assets. 220 into envelope percentage, 40%. 220 into 40%, how much it will be? 88. Step 4. Goodwill or gain on bargain purchase. Consideration 138 lakhs. add NCI value 88 lakhs less fair value of net assets. Goodwill. Post acquisition profit, be careful. Post acquisition profit work out பண்ணும்போது Q Limited's equity பாருங்க, other equity பாருங்க. Q Limited's other equity, how much was there at the beginning of the year? 80. What is the value at the end of the year? 90. And there is a change in the inventory value. Inventory value increased by 3. Then trade payable reduced here. So wait பண்ணுங்க. Opening balance of reserves and surplus. How much is given opening balance of reserves and surplus? 80. Add increase in inventory 3 because it will increase your profit. Add decrease in trade payable 2. So opening balance after adjustment, how much? 85. What is the closing balance of reserves and surplus of the other company? 90 is given. So post acquisition profit, what is the post acquisition profit? 5. Opening balance 85, closing balance 90. Therefore post acquisition profit is how much? 5. This will be shared by holding and subsidiary company in 60/40 proportion. 3 and 2 will come. NCA for balance sheet will be 88 plus 2. How much it will be? 90. Step 6. Reserves and surplus for balance sheet. Reserves and surplus for balance sheet. Okay. P Limited is reserves and surplus. How much is there? 150. End of the year. 150 plus pre post acquisition profit 3. 153. So in the balance sheet, goodwill how much will come? 6 lakhs will come. Reserves and surplus will be 153. NCA will be what? 90. Shall we? Have we taken up this? Live online friends, have we taken up this?
Yes, sir.
Shall we? What will be the equity share capital? Equity share capital of which company will come? P will come. How much? Equity share capital of P, 338 will come. Reserves and surplus of P, that is step 6. 153 will come, reserves and surplus. Then NCI will come. Step 5. NCI how much? 90. All these things will come under shareholders' funds. Then non-current liability, long-term borrowings. Long-term borrowings, how much will come? Purchase consideration shares la kodukkalingala. Adu investment already included, already recorded in the balance sheet. Year end, we are not doing year beginning balance sheet. We are doing which one? Year end balance sheet. Already it has been recorded in the asset side. Already it has been recorded in which one? Asset side. Already நம்ம asset side la record பண்ணிட்டோமே. This 138. Otherwise, in the shares இருக்கு இல்லையா, this will include purchase consideration given. Asset side la record ஆயிட்டாவே, what is the meaning? Asset side la 138 record பண்ணிட்டானாவே, already they passed a journal entry. What is the entry? Investment accounted out to equity share capital like that. Already they passed a journal entry. So borrowings, how much is there for this one? 100 plus 64. Then trade payables. Trade payables, year-end items. 50 plus 26, year-end. Example, please use a proper format. Classroom purpose it is okay. Asset side what will come? Plant, property and equipment. How much holding companies plant, property, equipment? 300 plus 276. Opening balance paranga. What is the change in fair value? 25. 300 plus 276. 300 plus subsidiary company oda book value par 190. 300 year end. 300 plus 190 plus and the revaluation. At the beginning of the year we revalued from 175 to 200. How much it will be? Revaluation 35. Huh? So 515 will come as PPE. Then goodwill will come. Step number 4. What is goodwill? 6. Next. What is the next one? What is the next one? Non-current financial assets will not come there. Other current assets. 120 plus 70. How much? Financial assets irka. Financial assets 120 plus 70. How much? 190. Then the revaluation depends. Oh, plus revaluation also. Plus revaluation how much? Minus 20. Minus 20. How much it will be? Then current assets. Current assets. Inventory. 80 plus 50. $821 it will tally. Here NCA we valued based on which one? Proportionate net assets. NCA valued based on proportionate net assets. Suppose a fair value method work panna answer mari. Fair value method work panna simple. For 60% we invested how much? 138 means what is for 40%. Fair value method le pottingana change out. Okay. 60% if it is 138 invested for 60%, what is for 40%? How much it will be? 90. 92. And this is 92 number. Maybe the note panning because in your textbook they have solved by this method, fair value method. Fair value method NCA 92 வந்திருக்கும். அதுக்கு ஏத்த மாதிரி goodwill மாறிடும். இது வந்து பாத்தீங்கன்னா 138 plus 92 minus 220 will give us what? 10 lakhs. If you go by fair value method, what will be the goodwill value? 10 lakhs. So asset side goodwill will be 10 lakhs. Automatically on the liability side 4 add ஆகும், asset side 4 add ஆகும். Sorry, 92 is clear. 92 plus 2. 92 plus 2. 92 plus 2, 94 ஆகும். 92 initial recognition plus NCA for balance sheet will be 92 plus 2. 92 plus 2 ஆகும். It will become how much? 94 ஆகும். So when you go by fair value method, this will change. Other values will be the same. 338 அதே தான் இருக்கும். 153 will be there. 94 this will be same. 164, 76. All the other values will be same. 515. This 170 will be same, 130 will be same. So this total will be changing by extra 4. So asset side and extra 4 will get added. This when you follow which method? Fair value method. In your textbook they followed which method? Fair value method. You can check the answer also. 1 minute, let me check. For example, this is a solution given. PPE 515. Yes, 515. Goodwill. How it is 10? They followed which method? Fair value method. That's why 10. Then inventories 130. Inventories 130. Same. Equity share capital 338. Same. Reserves and surplus 153. NCI, they proportionate net assets 90 in. If it is fair value method, it will become what? 94. NCI value is how much? 94 they have given. Nothing but fair value method. Borrowings same. Trade payable same. Shall we? Have you noted this? If fair value method is followed, NCA would have become 92. For balance sheet, it would have become what? 94. Goodwill would have become what? 138 plus 92 minus 220 would have become how much? 10 lakhs. If it is which method? Fair value method. For balance sheet point of view also, fair value method, that extra of 4 NCA would have come, that is hit by your goodwill extra of 4. Question number 4 is same model, but they asked you to value the NCA based on proportion in net assets. Live or inference, have you done this?
Yes, sir.
Shall we? Look at this. Company P acquired how much? 80% of shares in what? Yes, on 1/10/2020. 1/10/2020. Okay. Total fair value how much? 440 lakhs. Paid up value 100 lakhs. NCA should be measured at which one? Proportion in net assets. Partial goodwill they ask you. Total comprehensive income of P and S amounted to how much? 120 lakhs and 140 lakhs respectively. Extracts of balance sheet is given to us. $120 lakhs and $140 lakhs, they earned the total comprehensive income. Equity share capital they have given. Other equity they have given. They ask you to prepare which one? Consolidated balance sheet at the beginning of the year as well as what? Sorry, when the shares are acquired as well as what? End of the year capital. When shares are acquired? 1/10/2020 acquire பண்ணிருக்காங்க. And how much of profit earned for the year? 120 lakhs holding company, 140 lakhs which company? Subsidiary company. When shares are acquired? When shares are acquired? 110 2020 110 2020 அப்ப acquire பண்ணிருக்காங்க. That day net assets at fair value directly given to us 700 plus 320 minus 200 minus 300. How much is given? 520 lakhs is given to us. NCA should be valued based on which one? Fair value. Sorry, net assets. Based on which one? Net assets. So 520 into how much percentage? 520 into how much percentage? 20%. 520 into 20% will be how much? 104. We can work out goodwill or gain on bargain purchase and prepare the balance sheet. Prepare the balance sheet. Shall we? Start. This is illustration 4. On what date we are going to do this? 1/10/2020. 1/10/2020. Number 1. Proportion of shares held. What is the proportion we are holding? 80% is to 20%. Step 2. Fair value of net assets. Of which company? AS Limited. That is given in the question. No need to work out. 520. That is given in the question itself. 520 is given. Directly given. Next. What is the next one? NCI based on net assets. 520 into 20%. How much it is? 104. Goodwill or gain on bargain purchase. What is the consideration paid? What is the consideration paid for acquiring thing? Given 440. Add NCI value less fair value of net assets. What is the fair value of net assets? What is the fair value of net assets? So it gives us goodwill. Now they ask you consolidated balance sheet, right? As on what date? 1/10/2020. Equity share capital. Equity share capital. Paid up value how much? 100 lakhs. 100 lakhs we issued. So on 1/10/2020, wait, opening balance how much was there? Opening balance how much was there? 200. Okay. Now closing balance became how? We issued the shares for getting control over the other company. Equity share capital on 1/4/2020 was how much? 200. Add face value issued for acquiring control 100. Totally how much it will be? 300 will be the equity share capital component. Then other equity means reserves and surplus. Other equity means reserves and surplus. What is other equity? Other equity at the beginning of the year it was 240. 240 at the beginning of the year. $240 இருக்கு அப்புறம் then securities premium. Look at this. 100 lakhs, fair value 440 lakhs. Securities premium on allotment of shares. How much it will be? 340 lakhs. Face value issued is 100 lakhs, but fair value of the share is 440 lakhs. Now the premium will be recorded here. Premium will be recorded here. What else will come? What else will come? Think. What is the comprehensive income for the holding company? 120 lakhs. Comprehensive income up to that is 110/2020. What is the profit earned for the year? 120 lakhs into 6 by 12. 60 lakhs. So this will be other equity. I repeat, opening balance of reserves and surplus given in the adjustment 240. Securities premium in the allotment of shares for acquiring control is 340. Then comprehensive income up to 110/2020, that is 6 by 12 for 6 months. Okay, 640. Then NCI value on what date? 110/2020. How much? 104. Then what is the next one? Non-current liability. Non-current liability. How much? Non-current liability. 300 plus 300. Then current liability. Current liability எவ்வளோ கொடுத்திருக்கோம்? 300 plus 200. Please do it in a proper format in the exam. Then asset side என்ன வரும்? This is your liability side. In the asset side what and all will come? PPE பாருங்க. PPE, okay, we'll take which value? Fair value. What is the fair value? 700 plus 680. 700 plus 700 plus 680 என்ன வரும்? Then goodwill, how much of goodwill will come? 24 goodwill will come. Then current assets. Current assets. What is the current asset value? 420 plus 320. Fair value. 420 plus 320. How much? 7. That's it. This is a consolidated balance sheet on what date? 110/2020. That is when the shares are acquired. Before we go for the consolidated balance sheet at the end of the year, next step we have to work out. What is the next step we have to work out? Post acquisition profit we need to work out. Try பண்ணுங்க. This is consolidated balance sheet when the shares are acquired. When the shares are acquired, this is a consolidated balance sheet. Any answer for post-acquisition profit? Shall I? Listen. On 1/4/2020, listen, look at other equity, 130. 1/4/2020, reserves and surplus of which company? Yes. How much is given? 130. Add net profit up to 110, 2020. How to work out? The difference you can take 130 to 270. What is the net profit for the year? 130 opening balance, closing balance 270. What is the net profit for the year? 140. Or directly they have given 140 lakhs is given. So in the 140 lakhs, how many months will become pre-acquisition? 6 months. 70. Wait. There is a change in inventory. Current asset paranga. Current asset. At the beginning of the year, it was, sorry, when the shares were acquired, it was much. Yes, paranga. 360 to 320. 360 to 320. From 360, it became 320. Loss or gain? Loss. Less reduction in stock. Fair value. How much? 40. Then current liability from 300, the fair value became 200. So it's a profit. Add reduction in current liability. Reduction in liability. Change. Oh, no change. Huh? Sorry. This will give us balance on 1/10/2020. This is a balance on what date? 1/10/2020. What is the balance given on? Given on 31st March 2021 to 217. This difference will become post-acquisition profit. What is a post-acquisition profit? It's a middle year purchase. 110. I repeat, opening balance of reserves and surplus, net profit for the 6 months up to 1/10/2020. Till the middle of the year, it is pre-acquisition period, 6 months. Then there is a reduction in stock. So this becomes reserves and surplus balance on 1/10/2020. Reserves and surplus balance on 1/10/2020. Then balance is given on 31st March 2020. How much? How much is given? 270 kuduthirukanga. How much is given? 270 given. So post acquisition profit, this is the last 6 months profit, 110. 110. Wait, how much split? How much split? Holding company 80%. How much? 88. And NCA will be 20%. 22. Have you taken this balance sheet at the beginning of the year? Okay, take it. Step 6, NCA for balance sheet. What was the opening balance? 104 plus 22. 104 plus 22, share of post acquisition profit. Opening balance plus which one? Share of post acquisition profit. Next step, reserves and surplus for balance sheet. What is holding company's reserves? Holding company's reserves given. How much is given? 700. Plus share of post acquisition profit 88. Then let us prepare the balance sheet at the end of. Have we taken up the balance sheet? Balance sheet over. Now we have to prepare balance sheet as on what date? Maybe with format you can do in the exam. March 2021. Equity share capital. How much equity share capital? Holding company or equity share capital how much? 300. 300. Holding company's equity share capital 300. Reserves and surplus. You have done. Step 7. How much? 788. NCA. Step 6. How much NCA? 126 NCA. Then non-current liability 300, non-current liability at the end of the year 320 plus 310. Next, current liability at the end of the year. Current liability at the end of the year 530 plus 660. How much? At the end of the year. How much? Asset side, what and all will come? Asset side, what and all will come? Plant, property, equipment, as per balance sheet. As per balance sheet, at the end of the year, 720 plus 500 plus revaluation. Revaluation 400 to 700 it increased. 400 to 700 it increased. 440 to 700. 440 to 700. How much? 260. 1480 PPE1. Goodwill, there is no change in the value. What was the goodwill? 24. Current assets at the end of the year. Current assets at the end of the year. 500 plus 400. Shall we? Formula. Shall we? Start. Dividend from subsidiary company. Dividend from a subsidiary company. In separate balance sheet, what to do, we will see. In consolidated balance sheet, what to do, we will see. See, dividend from which company? Subsidiary company. In the separate balance sheet, what we should do? Dividend can be for pre-acquisition period, or dividend can be which one? Dividend can be pre-acquisition period or what? Post-acquisition period. Simple. If it is for the pre-acquisition period, your investment includes amount paid for dividend also. I acquire shares today. Dividend is declared for la period before this now. This amount of investment includes which one? Amount paid for dividend also. So simple. Eliminate from the cost of investment. Eliminate from the cost of investment. Dividend for the post-acquisition period, it is like return on investment. Okay. So dividend for the post-acquisition period should be included in which one? P&L. Sir, I invested money today. Let us assume 10 lakhs. You are paying dividend. Subsidiary company is paying dividend for the past period, which means the amount paid 10 lakhs include what? Come dividend. Come dividend. I paid including dividend. So eliminate from the cost of investment. If it is for the post-acquisition period, I invested money. After that, the subsidiary company earns profit and declares dividend. That is what? Return on investment. It will be included in which one? P&L. Resource and surplus. Take it. Suppose if it is a consolidated balance sheet, very, very simple. Okay. Dividend payable to NCA alone is deducted from the value of NCA and shown as current liability. Okay, whatever is payable to NCA belongs to outsiders. It belongs to whom? Outsiders. Deduct and show it under which one? Current liability. Take it. Shall we? Go to the next question. Which question? D company acquired how much percentage? 60%. On what date? 1st October 2020. Middle of the year they acquired shares. Retained earnings at the beginning of the year was 5,000. At the beginning of the year was 5,000. G Limited declared a dividend for 2021 given. They are declaring dividend for 2021. It is accounted in the books of G means the subsidiary company has recorded this already, but not accounted in the books of what? D. D Limited has not acquired. Holding company has not recorded the dividend. Who has recorded the dividend? Subsidiary company has recorded the dividend. Wait, pardon. They declared dividend for the current year. We acquired shares in the middle of the year. April to March accounting year. They declared dividend for the year. We acquired shares on 1st October. So the dividend, 6 months, 1 year dividend kuduthirukanga. The 6 months will become what? Pre-acquisition period. Remaining 6 months will become what? Post-acquisition period dividend. Prepared separate and consolidated balance sheet they ask. As on what date? 31st March 2021 they ask for. Okay. What is the total dividend declared? For separate balance sheet, what is the total dividend declared? What is the total dividend declared? 6,000. Adale, up to 1st October becomes which one? Pre-acquisition period. The holding company share in 6,000 into 60%, sorry, 6 by 12 pre-acquisition period into holding company order shareholder 60%. What is the amount? 6,000 6 by 12 into 60%. How much it will be? 1,800. It will be adjusted in which one? Then after 1/10/2020 it will be included in which one? Reserves and surplus. Included in which one? Reserves and surplus. Okay. So we'll first prepare the separate balance sheet. Aprama we'll go for consolidated balance sheet. Separate balance sheet prepare பண்ணும்போது first let us do which one? Separate balance sheet போடுறோம். Separate balance sheet போடும்போது equity and liability. Equity and liabilities பாருங்க. அதுல equity shares how much will be there? D limited. D limited, only D limited. How much? 50,000. Only D limited. Then retained earnings, reserves and surplus போடும்போது, what is the reserves and surplus of the holding company? 25,000 plus 1,800. It will become 26,800. This part. Then, what is the next one? Current liabilities. Only D. How much current liabilities? 29,000. We are preparing which one? Consolidated balance sheet or separate balance sheet? Separate balance sheet. Asset side போடும்போது PPE. Only D. How much? PPE of D how much? 60,000. Investment 24,000 less pre-acquisition dividend. How much? Then current assets. Current assets D how much is there? 22,000. Add dividend receivable. How much of dividend will receive? 6,000 into 60%. Total dividend receivable 3,600. Dividend receivable is an accrued income, right? 3,600. So total at 23,600 will come. Tally this. Total it. This is for which one? Separate balance sheet. Then we'll do consolidated balance sheet. Take up this. Out of the total dividend, first 6 months becomes pre-acquisition period dividend. It will be adjusted with which one? Cost of the investment. Next 6 months, that is return on investment included in which one? Reserves and surplus. Then we prepare a separate balance sheet. This is which question number? Illustration 5. First complete consolidated balance sheet, then we'll go for separate balance sheet. Sorry, complete separate balance sheet, then we'll go for which one? Consolidated balance sheet. Shall we? For consolidated balance sheet, consolidated balance sheet, we want the pre-acquisition and post-acquisition net worth clearly. What is the retained earnings at the beginning of the year? What is the retained earnings at the beginning of the year? 5,000 given. We can prepare retained earnings account. By balance brought down. You can do it in statement format also. 5,000. To balance carry down. What is the closing balance given retained earnings of the other company? What is the retained earnings of the other company? 11,000 given. And dividend they have recorded already. Dividend already they have recorded. How much they have recorded? Dividend 6,000 has been accounted in the books of G. If you tally this, you will get balancing for a net profit for the year. How much? 17 minus 5, how much you will get? 12,000. Or there is another method of doing. What is the closing balance of retained earnings? 11,000 minus opening balance. Opening balance how much? 5,000. This is net profit after appropriation. That is after dividend. Dividend as we have recorded 6,000. Add back dividend. Add back dividend how much? 6,000 add panna. You will get net profit before dividend. What is the net profit before dividend? 12,000. This is a net profit earned for the year. This is a net profit earned for the year. How much? 12,000. Either through ledger account you can work out net profit for the year before dividend, or closing balance minus opening balance you can do and find out net profit before dividend. So why should I do this? Because what is step 1? Proportion. What is the proportion of share sale? How much? 60% is to 40% proportion. Step 2, we want fair value of net assets on the rate of acquisition of shares. When the shares are acquired? 1st October 2020. Okay. Equity share capital at the beginning of the year. 1/4/2020. Subsidiary company. How much? Subsidiary company G Limited. Equity share capital, there is no change. 25,000. Then Retained earnings. Retained earnings at the beginning of the year. That is 1/4/2020. What is retained earnings at the beginning of the year? 5,000. Add net profit up to 1st October 2020. What is the net profit earned before dividend? 12,000. First 6 months. How many months? It will become pre-acquisition period profit. Add up, you will get fair value of net assets. On what date? On what date? 1/10/2020. Please remember, shares are not acquired at the beginning of the year. Shares are acquired in the middle of the year. So opening balance of equity, opening balance of reserves, and net profit for the first 6 months will give us fair value of net assets. In this question, there is no revaluation or whatever. How much you get? 36,000. Then NCA எப்படி வேல்யூ பண்ண சொல்லியிருக்கான்னு பாருங்க. NCA we can value based on at fair value. Simple. For 60% control, how much amount invested? For 60% control, how much amount invested? Asset side la irukum paru. How much amount invested? 24,000 na. For 40%, how much? How much? How much? How much? 16,000. NCA will be valued at what value? Fair value. Start. Then, as usual, what is the next one we will learn about? Goodwill or gain on cost of control. What is the consideration paid? What is the consideration paid? 24,000. Add NCA value 16,000 less net assets. And now you get which one? Goodwill how much? 4,000. Take up to this, then we will proceed. Any doubt in finding out profit for the year? Any doubt in finding out profit for the year? First 6 months we add with pre-acquisition period. Post-acquisition profit simple. That is earned after 1/10/2020. How much? $12,000 into 6/12. Split this between D Limited and NCA. How much it will come? What was the initial value of NCA? 16,000. And share of post-acquisition profit. What is the share of post-acquisition profit? 2,400. Don't forget, now only you have taken up the notes. In consolidated balance sheet, dividend payable to NCA alone will be deducted from which one? Value of NCA and shown as which one? Current liability. What is the dividend payable? NCA, 6,000 into எவ்வளோ பர்சன்டேஜுங்க, அவங்களோட ஷேர் டோட்டல் டிவிடெண்ட் டிக்ளேர்டு 6,000 into how much percentage, 40%. This will be shown under current liability. Reserves and surplus for balance sheet. What is the delimited reserves and surplus? Delimited reserves and surplus, other equity, retained earnings, 25,000. Add delimited share of post acquisition profit. What is the delimited share of post acquisition profit? So this will give us reserves and surplus for balance sheet. Dividend payable to NCA. Dividend payable to NCA, we deduct and show in current liability. Why? It is payable. NCA are outside shareholders. Okay, so that 40% we pay. Accidentally, it becomes the same. Need not be. NCA for balance sheet is 16,000. Any doubt in proportion? Any doubt in fair value of net assets? At the beginning of the year, net worth, add net profit for 6 months, it will give us fair value of net assets. NCA, at fair value we work out. Cost of control, consideration plus NCA minus net assets on 1/10/2020. We get goodwill. Post acquisition profit 12,000. It is 12,000 into last 6 months. We split between holding company and NCA. NCA normally we will take NCA plus share of post acquisition profit. Since the dividend is payable to NCA, that component we show it as what? Current liability. Then reserves and surplus for balance sheet. Reserves and surplus for balance sheet. Delimited reserves and surplus. Share of post acquisition profit will give us reserves and surplus for which one? Balance sheet. Now try to prepare the consolidated balance sheet. Shall we? Consolidated balance sheet போடலாமா? Equity share capital of D will come. Reserves and surplus, which step we have done? Step number 7. How much? 28,600 will come. NCA also will come. NCA also will come. NCA which step? Step number 6. How much? 16,000. Current liabilities, listen, current liability D, how much is there? Current liability D, current liability 29,000 plus G, how much? How much G? 10,000. 29,000 plus 10,000 plus dividend payable to NCA. Not 6,000. 2,400. That also you can include. Add up current liabilities you will get. 29,000 plus 10,000 plus dividend payable to NCA 2,400. Add up and tell me. Add up and tell me how much you get. 29,000 plus 10,000 plus 2,400. How much it will become? How much? $41. Asset side, PPE போடும்போது what you will take? PPE, there is no change. 60 plus 30, how much? 90,000. 90,000. Then, what is the next one? Goodwill. Goodwill. Step number 4. How much? 4,000. Current assets. Current assets add பண்ணுங்க வருது. Entirely think பண்ணுங்க. Wait. Who declared dividend? G declared dividend how much? 6,000. The dividend is declared, adjusted in G Limited. Adjusted in what? G Limited. That will be there in current liabilities of G Limited. That will be there in which one? Current liabilities of which one? G Limited. I am G Limited. I am declaring dividend. Adjusted the dividend. What is the entry I would have passed? P&L account data to dividend payable. The dividend payable would have been included in which one? Current liability. So G or the current liability எடுத்துக்கும் போது 10,000 minus 6,000. G or the current liability 10,000, that includes what? Please note dividend 6,000 would have been included in this. So it will become 31. How much? 29,000 plus 4,000 plus 2,400. How much? 35,000? Minus the 2,000, 35,400. I repeat, current liability of D 29,000, G 10,000 minus dividend payable could have been included. Because NCA alone we show separate. NCA alone we show separate. Please follow a proper format for preparing which one? Consolidated balance sheet. Done. We'll do the next question and we'll go for a small break, then we'll continue. Which illustration number? Go through illustration 6. Any doubt in it? Okay, equity share capital of D, reserves and surplus we worked out. NCA we worked out. Current liability D 29,000, G after eliminating the dividend, and of course dividend payable to NCA will be shown. PPE, okay, 60,000 plus 30,000. Then goodwill, current assets of D will D plus G. Read through illustration 6. I hope the answer is correct as per the book also. Correct, separate balance sheet total per 1,05,800 and 1,30,000. It matches. Next question, company P Limited is a listed company. Invests in Q Limited at a cost of how much? 66,000 by paying cash. During 2021, they made a profit of 20,000 and OCI how much? 10,000. The following alternative scenarios are presented. Please remember, these are all alternative scenarios presented. Case 1. Investment entails 25% of voting power and significant influence over Q. So it will be taken as what? Associate. P Limited does not have a joint control of Q, a joint venture. Q Limited is a joint venture. So it will have an influence. It will have which one? Definitely joint venture. Joint venture now we will go for which one? Equity method of accounting. Investment entails significant influence over Q, which is joint venture of P does not have a joint control over Q. Whatever it is, there is a significant influence over Q. There is a significant influence over Q. Point number 4, partner. P does not have a significant influence over Q. Now, then it will not become associate or joint venture. P Limited does not have a joint control or significant influence over Q, which is the joint venture. Then also there will be no consolidation applicable. Otherwise, let it be an associate or joint venture when the consolidation or equity method of accounting is applicable. Only when there is a significant control. Start. Ind AS 28 is applicable. Ind AS 28 is applicable for joint ventures and associates. For joint ventures and which one? Associates. For joint ventures and which one? Associates having 20% or more voting power. having 20% or more voting power. Having 20% or more voting power. Full stop. Separate line. Case 1, 2, 3. Case 1, 2, 3 requires application of Ind AS 28. Requires application of Ind AS 28. That is consolidated financial statement. That is consolidated financial statement applying equity method of accounting. Consolidated financial statement applying equity method of accounting. Applying which method of accounting? Equity method of accounting. Next, separate line. Case 4 and 5. Case 4 and 5. Since there is no joint control or significant influence. Since there is no joint control or significant influence. Since there is no joint control or which one? Significant influence, comma, Ind AS 28 is not applicable. Ind AS 28 is not applicable. Ind AS 28 is not applicable. Only separate financial statement should be prepared. 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 If you look at the explanation, that is what they would have given. Case 1, 2, 3, Ind AS 28 applicable. Case 4 and 5, okay, only separate financial statement is prepared. Next, pass journal entry in the books of P at the time of purchase of shares. What is entry will pass? Start. Investment account data to cash. Answer for B. Answer for B. Investment account data to cash. Investment account data to cash. Investment account data to cash. Next. Point number C. Start. Consolidated financial statement is consolidated financial statement. Consolidated financial statement. Consolidated financial statement is applicable for which case? Consolidated financial statement is applicable for which case? Case 1, 2 and 3. Start. For case 1, 2 and 3. How to do it? Initial investment. What is initial investment? What is initial investment amount? 66,000. We are not given net worth, etc. We cannot find out Google and all. And share of post acquisition profit. What is the post acquisition profit earned? 20,000 into 25% control. How much? 5,000. Add share of OCI. share of OCI. How much OCI? 10,000 into 25%. How much? 2,500. So investment for balance sheet. See, what is the journal entry we passed when we acquired investment? Investment account data. Which account? Cash account. How much you recorded? 66,000. Then again these two, how to recognize? Investment account data. The 7,500. Share of profit will be recognized in which one? Profit and loss account, or you can say other equity. OCA will be recognized in what? Next, this is case number 1 to 3. Case, okay. Separate financial statement applicable for all cases. That is case number 4 and 5 also separate financial statement. Simple there. Investments are recognized at cost. That is rupees how much? 66,000. Share of post acquisition profit and OCI are not considered. This is what they would have given also. You can find investment account data to cash. Investment account data 7,500 to P&L account to which one? OCI, like that they would have given. Or for case number 4 and 5, investment will be valued. There will be no consolidated and no separate financial statement. Otherwise, investment will be valued at what? Cost. Investment will be valued at cost. Take up this. Or another. Is it over? Go to illustration 7. We are given 31st March 2020 and 31st March 2021. Individual balance sheet, fair value kuduthirka, separate balance sheet, individual balance sheet, like that they have given. PPE 480, fair value how much? 700. Investment 60% of shares are acquired by issuing which one? Equity kuduthirukanga for 480. Current assets kuduthirukanga. Equity is given. Look at opening balance is 360. Closing balance is how much? 1070. This includes shares issued for investment purpose. The closing balance is clear, equity. This includes the shares allotted for the purpose of what? Acquiring other company shares.
Change in value number.
60% of shares are acquired by issuing which one? Equity. So this 480 is the equity issued by which company? Holding company. So this 1070 will include what? Shares issued. And again, remember, it is equity share capital or equity. Equity means this includes capital plus reserves and surplus. Capital plus which one? Reserves and surplus. They have given non-current liability and current liability. Prepare which one? Consolidated balance sheet means at the end of the year. Generally, it is asked at which one? End of the year. So, if it is asked at the end of the year, what is the step you have to apply? Proportion. Step 2. Then NCA. Do they ask you to value the NCA using a specific method? Do they ask you to value the NCA using a specific method? Any specific method again? Or we can apply fair value method. 60% to 480 na 40% केवल apply பண்ணி value. Or you can apply proportionate net assets method also. Anything is okay. If the examination question is silent, you can go for what? Proportionate net assets method also. Okay. So, for uniformity in answer, let us maintain proportionate net assets. NCA value pardon. What is step 4? You will get goodwill or gain on bargain purchase. After this, you work out. Thereafter, I will work out the other things. Post acquisition profit law, I will work out. Work out the first 4 steps. What is the proportion? What is the fair value of net assets? On what date? 1/4/2020. What is the consideration paid? What is the opening balance of equity given? With that, adjust for that current assets and current liability. Fair value change, current assets 350 to 300. Less reduction in current asset. It will reduce your net worth. How much? 50. Reduce your profit by 50. Then current liability reduced. How much? 30. This is net opening balance. How much? 280. What is the closing balance? Equity given for the other company. Closing balance of equity given for the other company. 360. Subsidiary company. 360. So difference is nothing but net profit for the year. Thus becomes post acquisition profit. So split this between which company? What is this holding company? Or P Limited and which one? NCL. This into eவ்வளவு percentage? 60%. This into 40%. NCA for balance sheet. What is initial recognition? 196 plus 32. Step 7. Equity for balance sheet. We are not given capital and reserves. Equity for balance sheet. What is the equity? 1070 plus post acquisition profit 48. Triple 18 will come for balance sheet. Consolidated balance sheet. What will be the equity? Step 7. We are not given capital and this one separately. 1818 will come. Then what else will come? Equity includes reserves and surplus. NCI. Step 6. Then non-current liability. Non-current liability, be careful. 360 plus 330 plus revaluation 10. Opening balance paranga 300 to 310. 300 to 310. Revaluation 10. So how much it will come? Current liability 340 plus 210. Asset side PPE how much? 500 plus 150 plus revaluation opening balance. 750 plus 500 plus revaluation of the opening balance 480 to 700. How much? Totally how much it comes? 1000. Then what is the next one? Current assets. Okay, goodwill will come. Goodwill, intangible asset. In the proper format, please follow in the exam. Then current assets. How much current assets? 400 plus 540. Please remember, we are not given bifurcation of which one? Capital and reserves and surplus. Equity includes capital plus what? Reserves and surplus. Done. Matches with the textbook answer. They would have done some calculation and also don't ignore that. Just check it. 1470, 186, 940, 2596. Tell me. Go to illustration 8. Go to illustration 8. It's a similar question to whatever you've done now. We acquired 60% of shares at a cost of 1,50,000. We issued at market price of 25. So how many shares would have been issued? 1,50,000 divided by 25. Na? How many shares they would have issued? 6,000 shares into 10 face value and the extra 15 premium like that. Okay, let's see. They asked you consolidated balance sheet at the beginning of the year as well as at the end of the year. Confused ஆகாதீங்க. Ind AS 103, Ind AS 110 கொடுத்திருக்காங்க. And separate balance sheet also they asked. Okay, so don't get confused. Is it amalgamation or consolidation and confused ஆகாதீங்க. Ind AS 103 applicable for fair value accounting. Fair value accounting. According to that, we do which one? Ind AS 110 account. So it's actually holding and subsidiary company. Holding and subsidiary company. So on 1/4/2020, we have to prepare both separate and consolidated balance sheet. At the end of the year, you have to prepare a balance sheet. First 4 steps, stop. What is first 4 steps? Proportion of shares, fair value, NCI, cost of control. Stop there and do what? Balance sheet at the beginning of the year. Continue the remaining steps, prepare the balance sheet at the end of the year. Simple. Same like previously we have done the question. This is illustration number 8. What is the consideration paid? 1,50,000 divided by 25. Divided by 25. How many shares are issued? 6,000 shares are issued to gain how much control? 60% control. So proportion is 60% to 40%. Then everything at fair value. PPE 2,10,000. Current assets. Inventory how much? How much? Inventory 54,000. Financial assets 50,000. Borrowing how much?
60,000.
60,000. 20.
5,000.
This will give us fair value of net assets. NCA fair value போட்டுக்கலாம். 80% how much they invested? 1,50,000. Sorry, 60% 1,50,000. 40% how much? How much? One lakh will come. 1,50,000 divided by 60 into 40. This will come. Journal entry pass panna. This is 2,10,000. Journal entry kekla. Why unnecessarily? Consideration paid is how much? 1,50,000. NCA value 1 lakh minus fair value of net assets 2,29,000. Goodwill 21,000. At the beginning of the year போடும்போது what will be the share capital? 2 lakh plus the face value of shares issued. $6,000 shares into 10. 6,000 shares into 10, 60,000 more. When you do other equity what will come? What is other equity given? 1,20,000 plus the 6,000 shares are issued at a premium of 15. 25 rupees market value rate, 10 rupees face value, 15 rupees premium. 2,10,000 will come. Non-current liabilities, separate financial statement only which company will come? Borrowing 60,000 will come. 60,000 money. At the beginning of the year, how much? 60,000, correct. Trade payable at the beginning of the year. Who acquired shares? Sky order the separate financial statement, 90,000. Current liability, how much is given? At the beginning of the year. Plant, property, equipment at the beginning of the year, 2,80,000. Investment in S, how much will come? 1,50,000. Subsidiary come. 1,50,000 will come. Then inventory separate financial statement only. This one, how much? 70. Then financial assets, how much will come? 1 lakh. Consolidated accounts prepare பண்ணும்போது what will you do? This will be same, 2,60,000 will come. Then other equity how much? Other equity same, 2,10,000 will come. NCI, how much NCI will come? Initial recognition of NCI, 1 lakh will come. Non-current liability, add both. What is non-current liability? 60,000 plus 90,000 or 64,000 plus 90,000? 64 plus 90. 64,000. No. Borrowings பாருங்க 60,000 plus 90,000 how much 1,50,000. Trade payable 25,000 plus 44,000. 25,000 plus 44,000 how much? Then asset side போடும்போது PPE how much 2,80,000 plus இங்கே 2,10,000 fair value how much? Goodwill 21,000. Investment will not come. Inventory fair value 54,000 plus 74,000. 54,000 plus 74,000. Then financial assets 50,000 plus 1 lakh. This is at the beginning of the separate and consolidated financial statement at the beginning of the year. How this non-current liability comes? 90 plus 60. How current liability? 44 plus 25. PPE 280 plus 210. Inventory 74 plus 54. Financial assets this is at the beginning of the year. Then step 4 continue பண்றது which one? Step 5. Find out post acquisition profit. First company is a subsidiary company. இல்ல? How much opening balance other equity? Increase in inventory. Inventory will increase 45 to 54. How much increased? 9,000. Then decrease in trade payable. How much? What is other equity at the end of the year? So therefore post acquisition profit. Split this which ratio? 60% of 16,000, 12,000,
9,000.
and NCA
6,000.
step 6 NCA for balance sheet. What was the initial regulation? 1 lakh plus 6,400 now. Step 7 reserves and surplus for balance sheet. What is the reserves and surplus of the holding company? What is the reserves and surplus of the holding company? 2,40,000 plus share of post acquisition profit. This is the same like the other problems that we worked out. Financial assets we'll adjust in the balance sheet, and the fair value we change we'll adjust in what? Balance sheet. Now we have to prepare separate and consolidated balance sheet at the end of the year. Have we taken up step 4? Step 4 over. Step 5. Okay. Shall we? Separate balance sheet first you prepare. That is on which one? Sky Limited. 31st March 2000. Equity share capital, separate balance sheet, what will come? This 2,60,000. Consolidated also 2,60,000. Other equity, only Sky. How much? Sky. Other equity, how much? 2,40,000 in separate balance sheet. Step number, which step number? 7. 2,49,600. NCI will come only in this one. How much NCI? Non-current liability, only Sky will come. How much? Non-current liability, borrowing, Sky, how much will come? This 1 lakh will come. Here 1 lakh plus 64,000. Then revaluation paranga. Any revaluation? Opening balance 60 we have taken the same. No revaluation. So 1,64,000 will come. Then trade payable, current liability only Sky will come. How much? 50,000. இங்கே போடும்போது 50,000 plus 44,000. 31,000. 50,000 plus 31,000. 81,000. Don't adjust current assets, current liability here. That is adjusted in what? Profits. Plant, property, equipment. Only Sky will come. How much? 3 lakhs. 3 lakhs plus the other one. 2,06,000 plus revaluation. Plus revaluation 194 to 2,10,000. 194 to 2,10,000. How much total? Goodwill, step number 4. How much? Investment will come as it is. Separate balance sheet investment will come. How much? 1 lakh. Inventory, how much? 80,000, that is 50,000 plus 31. Sorry, 8. No inventory. Inventory 80 plus 58. Then financial assets. 1,20,000 plus 98,000 plus revaluation. Minus revaluation 88 to 50,000. 88 to 50,000. From 88 we reduced to 50,000. How much? So net 1,80,000. Inventory of the holding company will come. Inventory of the holding company, how much? 80,000. Tallies. Classroom problem tally. This is similar to earlier we have done a problem, right? Only numbers are different. Illustration 9 you can try it at home. You can try it at home. Which illustration? 9. Go to illustration 10. That is similar to the dividend adjustment we had seen. We have learned dividend adjustment, right? The same kind of a problem, only numbers are different. Here also shares are acquired in the middle of the year. So first half will become capital profit, next half will become what? Revenue profit. And dividend also, first half will become pre-acquisition dividend, next half will become what? Post-acquisition dividend, same concept. Separate and consolidated balance sheet. Try பண்ணுங்க. We'll do that. So this is like which illustration we have done? Illustration 5. We complete printing. Have we done this? I'll wait. Only printing over other. Is it done? Over. First analyze about the dividend declared, then we will continue. Illustration 10 done. Okay, 1/10/2020 for 30,000. They made a profit of 20,000 for the year and declared a dividend of what? 9,000 is given to us. 9,000 is given to us. NCA is valued based on what? Proportionate net assets. Proportionate net assets கொடுத்திருக்காங்க. Actually, they made a typing error. The typing error is Q Limited makes a profit of 20,000. There is not profit of 20,000. Actually, had other equity at the beginning of the year. இது தப்பு. Profit of 20,000 கிடையாது. Please correct. ஏன்னா சொல்யூஷன்ல பார்த்தா தான் நான் தெரிஞ்சது. Other equity at the end of 15,000. Dividend declared how much? 9,000. Minus profit for the year less பண்ணணும். Okay, to find out opening balance. This way also we can do. Okay, let us do reserves and surplus. What is the total dividend declared for the year? 9,000. அதில் 1st October வரைக்கும். Okay, up to 1st October it will become pre-acquisition. Up to 1st October it will become what? Pre-acquisition. In separate financial statement. This is start. In separate financial statement. Total dividend is 9,000. Up to 1st October is pre-acquisition dividend. Pre-acquisition dividend. So how much? 9,000 into 6/12 into how much holding company holds? 60%. How much it will be? It will be adjusted with cost of investment. 9,000 into 6/12 into 60%. 2,700 will be included in what? Reserves and surplus. So when you prepare a separate balance sheet, equity share capital of the holding company, how much? 50,000. Equity share capital, how much? Sorry. Equity share capital, how much? 60,000. Then reserves and surplus will be this 25,000 plus and the dividend. What is the dividend? Then current liabilities, only the P Limited current liability will continue. How much? Wait. Asset side, PP of P will continue. How much? Investment develop. What is the investment we have done? How much of investment we have done? 30,000 minus pre-acquisition dividend. How much? Current assets. 20,000. Add dividend receivable. Add dividend receivable. Total dividend receivable. 9,000 into 60% we would receive. How much? This is which one? Separate financial statement. First take it up. Then we'll go for consolidated financial statement. இந்த கொஸ்டின்ல dividend கொடுத்துட்டாங்க. Closing balance is also given. Closing balance, other equity 15,000 given in the question. Net profit for the year is also given in the question. So opening balance is the balancing. Net profit for the year is given in the question. Or none. Shall we? Live online friends, have we completed up to separate financial statement? Have we completed up to separate financial statement? Shall we? So opening balance, we get it as a balancing in the question. Okay, we'll work out the other steps. For consolidated balance sheet, other steps. Proportion of shares held, 60%, 40%. Step 2, we want fair value of net assets on 1/10/2020. What is the equity share capital at the beginning of the year for subsidiary company? What is equity share capital of the subsidiary company at the beginning of the year? How much is given? No change. So 25,000. Retained earnings at the beginning of the year, how much? 4,000. Net profit. What is the net profit earned for the year? What is the net profit earned for the year? 20,000. How many months it will become pre-acquisition profit? How much? 6/12. So it will be 39,000. NCA. NCA. How to value NCA? $60% எவ்வளோ இன்வெஸ்ட் பண்ணியிருக்கோம்? How much we invested? Wait பண்ணுங்க. இது any method they tell you for look at this. NCA is valued based on what? Proportionate net assets. So we cannot apply this method. NCA based on partial goodwill method. How much? 39,000 into how much percentage? 15,600. What is the consideration paid? 30,000. NCA 15,600. Net assets 30. Should get goodwill 6,000. 600. Post acquisition profit 20,000 into 6/12. 10,000. NCA for balance sheet. Initial recognition. What is initial recognition of NCA? 15,600. Share of post acquisition profit 4,000. Dividend payable to NCA will be shown separately in the balance sheet. What is the dividend payable? 9,000 into 40%, how much? Reserves and surplus for balance sheet. What is holding company's reserves? Other equity power 25,000. Add which one? P limited share of post acquisition profit. How much? Then let us prepare the balance sheet. What is the equity share capital? How much? 60,000. Reserves and surplus 31,000. NCA value for balance sheet 16,000. Then what else will come? What else will come? Trade payables Trade payables, how much will come? 15 plus 9, 20. Then other current liability, dividend to NCA. Dividend payable to NCA will come as what? Other current liability. How much? Asset side, plant property equipment. What is the plant property equipment value? 50 plus 30, how much? Goodwill, we worked out. Goodwill, we worked out. How much? Then, what is the next one? Current assets of both the company. How much? 40? That's it. Italian. One. Done. This is over. Over. Okay. Next question is a simple one. Okay, where the holding company is selling the investments. Holding company is what? Selling the investment. When holding company is selling the investment, what will happen? Its control will come down and NCA value will go up. NCA value will what? Go up. Look at this. BB Limited acquired 90% of shares for how much? 10 lakh 80. 90% of shares for 10 lakh 80. Fair value of the net assets was 10 lakhs. Okay, it doesn't matter. During current year, they made a profit of how much? 2 lakh. On that date, BM sold 15% of holding to outsiders for how much? 2 lakh 20,000 கொடுத்திருக்காங்க. Pass journal entry for the sale of partial holding, retaining control. Okay. What was the net assets at the beginning of the year? 10 lakhs. How much of income they earned? 2 lakh. So what is the net assets at the end of the year? 12 lakhs. When we sell our investment, the NCA value will what? NCA value will go up. NCA value will go up. So 15% will be 12 lakh into 15% will be 1 lakh 80,000. This is the value of NCA that is going to go up. Okay. But we sold the investment for how much? 2 lakh 20,000 means is it a profit or loss? Profit. It will be credited to reserves and surplus. It will be credited to reserves and surplus. When you buy the investment, what is the entry? Investment account debtor to cash. Inge we are selling the investment. We are selling the investment. Bank account debtor. Because of that, NCA will go up by how much? 1,80,000. Profit will be recognized in which one? Other equity. This journal entry is in consolidated balance sheet. Consolidated balance sheet. Bank account debtor 2,20,000. Sale price. NCA goes up by 1,80,000. Credit NCA. Other equity how much? 40,000.